If your consolidated financials don't tie and you keep teasing plugs, you're not bad at accounting, you're missing 3 elimination steps. I'm a CPA and I've reviewed a lot of consolidations where the math was fine but the logic wasn't. What you learn. When you should consolidate. The 4 core consolidation entries. Where intercompany breaks. What reviewers ask for. Step by step. Confirm control plus consolidation percentage. Don't guess. Align periods plus accounting policies. Combine TBs line by line. Post eliminations. Intercompany AR/AP, intercompany sales, COGS, dividends, equity, investment versus equity. Examples. Example 1. Parent bills. Sub for management fees, eliminate revenue, expense and the AR/AP. Example 2. Parent sells inventory to sub, eliminate intercompany sale, watch unrealized profit in ending inventory. Reviewer notes. Red flags, plugs, weird margins, IC balances not netting. What reviewers look for? IC tie-out by partner, consistent percent ownership, elimination JE support, mapping consistency, FX policy alignment. Supporting docs, IC schedules, ownership chart, elimination JE package. Checklist recap, ownership, support, same dates, policies, TB mapping logged. IC, AR is equal to AP by entity. IC, Rev is equal to IC EXP. Eliminate investment equity. Inventory, profit check. Final flux scan. If this sounds like your close process, you're not alone. Drop a comment with your toughest elimination. Like plus subscribe for more CPA walkthroughs.